Gold just crashed from $5,600 to $4,079, over 10% wiped out in a single session, and this move could determine whether you buy the opportunity of the decade or catch a falling knife. The moment Trump named Kevin Warsh as Fed chairman, precious metals collapsed. If you own gold, trade gold, or are thinking about buying gold, this affects you directly. This isn't what most people think it is. This isn't a trend reversal. This is a reset. There's one pattern the headlines are missing. The long tail on Friday's candle tells you buyers are still there. They're not running. They're waiting. I've tracked precious metal cycles through 3 bull markets. When a rally gets stretched, it needs to breathe. When positioning gets crowded, it needs to flush. What happened Friday wasn't the end of the gold bull market. It was the release valve. The last time gold corrected 10% or more in a single day was 2013, and it rallied over 40% in the following 12 months. By the end of this, you'll understand exactly why gold crashed, what the technical structure tells us, and what happens next. This isn't about politics. This isn't about ideology. This is about incentives, pure, cold, unavoidable incentives. When gold drops 10% in a day after an extended rally, while the structural drivers remain unchanged, you don't panic, you prepare. Here's the answer. 3 data points, 3 market signals. Each one alone is significant. Together, they create a lollapalooza, a compounding of forces that explains exactly what's happening in gold. But the third data point is the one that separates amateurs from professionals. And the real opportunity isn't in the crash, it's in what comes after. The crash wasn't random. It had a catalyst. Trump named Kevin Warsh as the next Federal Reserve chairman. Now here's why that mattered so much to gold. Warsh is perceived as a conservative pick, a former Fed governor with a preference for tighter policy. His nomination provided something markets desperately needed, a sense of stability. After months of speculation about Fed independence, Warsh calmed nerves, and that calm triggered a massive unwind. Gold dropped over 10%. Silver collapsed over 30%. Copper stocks, uranium, critical materials, double-digit losses across the board. Pause. Forget the headlines. Think like capital. When uncertainty is high, capital flows into safe havens. Gold benefits. When uncertainty drops, even temporarily, capital repositions. Gold sells off. That's exactly what happened Friday. The precious metals rally had been stretched. Demand had been building on global instability. Long-term structural trends had pushed positioning to extremes. Warsh's nomination was the release valve. Here's the short version. A blow-off like this resets the market for the next move. It flushes out weak hands. It shakes out leveraged positions. It creates the foundation for the next leg higher. Here's the key insight most people miss. The long tail on Friday's candle, in both gold and silver, indicates that buyers are still there. They stepped in at the lows. They absorbed the selling. That's not what a trend reversal looks like. That's what a healthy reset looks like. When incentives align like this, outcomes stop being opinions and become math. Bookmark this. We'll test these predictions in 90 days. But the structural picture is even more important. Keep this in mind. It connects to everything that comes next. And this is where most analysts get it wrong. They look at the price action in isolation. They see a 10% crash and assume the trend has changed. But the technical structure tells a different story. If you bought gold above $5,000, this is your roadmap. If you're thinking about entering now, wait for this signal. Here's the key level that matters: $4,000. Above it, the bullish structure is intact. Below it, reassess everything. Let me explain why this level is so important. Gold has been trading within a structural bullish pattern since 2024. Ascending triangles formed throughout the year. Each consolidation sparked another rally. Each rally produced higher highs. The break from $4,400 sparked a $1,000 per ounce move toward $5,400. But this time the target was breached. Gold produced a high of $5,600. And then came Friday, a historic one-day decline to a low of $4,679.50. Pause here. This chart decides whether you're early or late. Now here's what the levels tell us. $4,400 to $4,600 is the first support zone. If gold holds here, expect consolidation before the next rally. A break below $4,400 could introduce further downside to $4,000. But $4,000 is the line in the sand. Below $4,000, the bullish structure breaks. Above $4,000, the bullish structure remains intact. If you're holding gold, this part matters. The drop from $5,600 to $4,679 was violent, but it didn't break the trend. It reset the trend. That's an important distinction. According to World Gold Council data, central banks purchased over 136 tons in 2024 alone. That structural demand doesn't disappear because of one volatile day. This is the turning point, and this is where patience separates winners from losers. Now here's where this gets personal for your portfolio. The short-term noise is loud, but the long-term signals are unchanged. Let me walk you through 3 macro forces that still support the gold thesis. Screenshot this. You'll want these 3 forces saved when the next rally starts. Force 1. The dollar remains structurally weak. The US dollar produced a low at 95.50 in January 2026. It rebounded toward resistance at 97. But this consolidation around long-term support doesn't change the bearish structure. A break below 95.50 would signal a quick drop toward 90. A recovery above 150 would introduce short-term uncertainty. But the structural trend remains bearish, and a weak dollar is bullish for gold. Force 2. Central banks are still buying, and supply constraints are real. Central banks are still net purchasers of gold. The demand is structural. It's not driven by speculation. It's driven by de-dollarization, by reserve diversification, by the same forces that have been pushing gold higher for years. According to IMF data, global central bank gold reserves increased by 8% in 2025, the largest annual increase in over a decade. And here's what the Fed cannot fix. It cannot produce the 7 critical metals needed for military manufacture. That was made clear when the US-China Busan summit ended. China agreed to suspend export controls on rare earths, but stayed silent on defense-grade materials. Supply constraints aren't monetary. They're physical, and they're not going away. Force 3. Trust doesn't rebuild overnight. Here's the final piece of the macro puzzle. Global trust, once lost, doesn't come back in a day. The structural shift toward hard assets is generational. It's not going to reverse because one Fed chairman nomination calmed markets for 48 hours. A conservative Fed chair can calm markets temporarily, but he can't fix fiscal volatility. He can't reverse de-dollarization. He can't rebuild trust that took decades to erode. This is where amateurs panic and professionals accumulate. Why these 3 forces together create the real picture? If you're still unsure whether to hold or sell, this next part makes the decision obvious. Now let's connect the dots. Because this isn't random, this is a pattern. You have a positioning reset, triggered by the Warsh nomination, flushing out weak hands and creating a healthier market structure. You have a technical structure that remains bullish. As long as gold holds above $4,000, the trend is intact. You have a macro backdrop that's unchanged. Dollar weakness, central bank buying, supply constraints, and geopolitical uncertainty all remain in place. 3 different time frames, 3 different perspectives. One conclusion: this is a reset, not a reversal. Relief corrections shake out the impatient. They reward the prepared. When incentives align like this, markets don't reverse. They consolidate and continue. Now let's invert. What would have to happen for the gold bull market to end? The dollar would have to stage a sustained rally above 150. Central banks would have to become net sellers of gold. Supply constraints on critical metals would have to ease. Geopolitical tensions would have to resolve globally. Does that sound likely to you? I didn't think so. Here's the math that matters. Gold dropped from $5,600 to $4,679. That's a 16% pullback, but it's still above $4,400, the breakout level. Still above $4,000, the structural support. When incentives align like this, the outcome stops being a guess and becomes a mathematical inevitability. Gold may consolidate, it may test lower levels, but until the structural drivers reverse, this is a reset, not the end. By mid-2026, we'll know if this was the bottom or just the first leg of a deeper correction before the next rally. Climax plus payoff. So where does this end? Let me give you the honest assessment. The bull case. Gold holds above $4,400. Consolidation forms a new base. The next rally targets $6,000 or higher. The structural thesis plays out. The bear case, gold breaks below $4,400. Tests $4,000 support. If $4,000 breaks, expect a deeper correction. But even in this scenario, the structural thesis isn't dead, just delayed. The most likely case, consolidation between $4,400 and $5,000. Volatility as markets digest the Warsh news. A reset that prepares for the next leg higher. Here's the sentence that tells you everything. The forces driving gold higher are bigger than any one nomination. This isn't noise. This isn't politics. This is a structural shift. And by the time most people realize the correction was a buying opportunity, the next rally will already be underway. So what do you do with this information? 3 things. Cold, logical, no emotion. First, understand this is a reset, not a reversal. The 10% drop was violent. But the technical structure remains bullish above $4,000. Don't let one day of price action override the bigger picture. Second, watch the key levels. $4,400 to $4,600 is first support. $4,000 is the line in the sand. Above $4,000, the bullish thesis is intact. Below $4,000, reassess. Third, let the dust settle. Investors must be careful in the short term. Allow volatility to calm before entering new positions. The opportunity isn't going anywhere, but catching a falling knife isn't strategy. It's gambling. None of this is advice. All of this is arithmetic. The structural drivers for gold haven't changed. The dollar remains weak. Central banks are still buying. Supply constraints persist. Geopolitical uncertainty isn't easing. What changed was positioning, not fundamentals. When positioning resets while fundamentals remain strong, that's not a crisis. That's an opportunity. This isn't about morality. It's about simple arithmetic. Subscribe if you want to think like capital, not like victims. I'll keep following the numbers so you don't have to guess. The dollar just hit a 4-year low. And if you hold cash, this could quietly destroy your purchasing power. Let that satisfactorily sink in, because most people won't understand what this means until it's too late. The world's reserve currency, the backbone of global trade, the asset every central bank holds as their ultimate safety net, down over 1% in a single day, lowest level since 2021. And when the president was asked if the dollar had fallen too much, he said the value of the dollar is great. Pause for a second. This part matters more than people realize. The man who controls American trade policy just told you he's fine with your dollars buying less. Now watch carefully. This isn't just a currency move, this is a signal. Gold just hit a record above $5,280. Oil surged to a 4-month high. The euro broke 1.20 for the first time in 4 years. The Australian dollar spiked to a 3-year high. And here's the part that should keep you up at night. While all this is happening, the Federal Reserve is walking into a rate decision under criminal investigation of its own chairman. A sitting Fed governor faces removal. A successor is being nominated in weeks. This is where people get blindsided. When the world's most powerful currency falls this fast, while the central bank is under political siege and the administration shows no urgency to stop it. That's not volatility. That's not noise. That's a regime change in motion. This mirrors what happened before the 1970s dollar crisis, when confidence cracked and the entire monetary system had to be rebuilt. By the end of this, you'll understand exactly why this outcome was predictable and what happens to everyone who ignores the signals. This isn't about politics. This isn't about ideology. This is about incentives. Pure, cold, unavoidable incentives. I've spent decades watching currencies, watching capital flow, watching what happens when the people who control money face pressure they can't escape. And I'll tell you something simple. When you see the dollar falling, gold surging, and the central bank under siege, all at the same time, you don't ask if something is wrong. You ask what's breaking. Here's the answer. 3 data points, 3 pressure points. Each one, alone, is significant. Together, they create a lollapalooza, a compounding of forces that makes the outcome almost mathematically certain. But the third data point is the one that turns concern into certainty. And this is where the pattern becomes impossible to ignore. Here's the first number, 96.27. That's where the dollar index sits right now, the lowest in 4 years, down over 1% in a single session, the sharpest sell-off since Trump's tariff blitz rocked markets last April. Now here's why this matters to you personally. The dollar index measures the U.S. currency against 6 major rivals: euro, yen, pound, Canadian dollar, Swedish krona, Swiss franc. When this index falls, it means the dollar is weakening against all of them simultaneously. Think about what that means for your daily life. Everything America imports, electronics, cars, clothing, food ingredients, gets more expensive. Your dollars buy less, even if your paycheck stays the same. And here's the part nobody is paying attention to. This isn't happening in a vacuum. Jan von Gerich, Nordea's chief markets analyst, explained it clearly. Last week, when there seemed to be a flight from the U.S. in general, you had equities falling, treasuries taking hits, and the dollar falling. Now it's more of a dollar story. Pause for a second. This part matters more than people realize. Last week, everything American was getting sold. Stocks, bonds, currency, all of it. That's not normal profit taking. That's capital flight. This is like the foundation of a skyscraper starting to crack. You don't see it from the street, but the engineers are panicking. Now it's concentrated on the dollar. And this is where it gets worse. When asked whether the dollar had declined too much, Trump said the value of the dollar was great. Guy Miller, chief market strategist at Zurich Insurance Group, translated what that really means. Despite the falls in the dollar over the past 12 months, it was coming from a very rich level and even today is not particularly cheap. Consequently, I don't feel the administration is in any rush to try and arrest the decline. Read that again. The administration sees no urgency. The dollar is falling, and the people who could stop it, they don't want to. If this continues, the cost of living quietly rises, even if your income doesn't. When incentives align like this, outcomes stop being opinions and become math. And this is where the system starts cracking. Keep this in mind. It connects to everything that comes next. Now the second data point. This one isn't a number, it's a situation. And this situation changes everything. The Federal Reserve is holding a rate decision meeting today. Rates are expected to stay steady. But here's the dangerous part. This meeting is happening while a criminal investigation is underway targeting Fed Chair Jerome Powell. An evolving effort is in motion to fire Fed Governor Lisa Cook. A successor to Powell is being nominated in May. Pause for a second. Let that satisfactorily sink in. The chairman of the world's most powerful central bank, under criminal investigation by his own government. Jan von Gerich put it simply. The most interesting thing about the Fed tonight is that Powell could now say something more on this political pressure, because he's refrained from all of that so far. Think about what that means. Markets are waiting to see if Powell will finally acknowledge the pressure. And here's what most people don't understand. Central bank independence isn't just a nice idea. It's the foundation of currency credibility. Think of it like this. The Fed is supposed to be the referee in a game where trillions of dollars are on the line. When investors trust that the referee makes calls based on rules, not politics, they trust the game. When that trust cracks, capital moves, and it's already moving. The dollar's 4-year low isn't happening in spite of Fed uncertainty. It's happening because of it. Now the pattern becomes impossible to ignore. This isn't a coincidence. It's a system signal. But the third data point is where concern becomes certainty. Now the third data point, and this is the one that makes the outcome inevitable. 3 numbers that tell one story. Gold, record high above $5,180 an ounce. Brent crude, 4-month high above $68 a barrel. Euro broke 120 for the first time since 2021. Australian dollar, 3-year high above 70 cents. Now here's the trick. All of these assets have one thing in common. They're priced in dollars. When the dollar falls, everything denominated in dollars becomes cheaper for foreign buyers. Gold gets more attractive. Oil gets more affordable. Other currencies gain relative strength. This is mechanical. This is arithmetic. And here's where the math turns into fate. When gold hits a record high on the same day, the dollar hits a 4-year low. That's not coincidence. That's repricing. The market is telling you something. It's saying, we trust the rock more than the paper. Pause for a second. This is where it gets personal. If you hold savings in dollars, a bank account, a money market fund, cash under the mattress, those dollars now buy less gold, less oil, less of everything priced globally. Your wealth is being diluted in real time, even if your bank balance looks the same. And this is where the system starts cracking. European central bank policymakers are flagging growing concerns. The euro's quick appreciation is worrying them. They're warning it could drag inflation down below their 2% target. Think about that. The ECB is worried the euro is getting too strong because the dollar is getting too weak. This creates a feedback loop. Dollar weakness forces other central banks to respond. Their responses create more instability. More instability drives more capital into safe havens. Gold rises, dollar falls further. The loop accelerates. When trust in money cracks, everything priced in it must reset. Why these 3 forces together make the outcome inevitable. Now let's connect the dots, because this isn't random. This is a pattern. You have the dollar at a 4-year low. and an administration showing no urgency to defend it. You have the Federal Reserve under political siege, its independence questioned at exactly the wrong moment. You have every dollar-denominated asset repricing, gold, oil, and rival currencies all moving against the greenback simultaneously. 3 different pressure points, 3 different sources, one direction. When incentives align like this, the outcome stops being a guess and becomes a mathematical inevitability. Now let's invert. What would have to happen for this to reverse? The administration would have to signal it wants a stronger dollar. The Fed investigation would have to disappear. Powell would have to project total independence and confidence. Geopolitical tensions would have to ease globally. Does that sound likely to you? I didn't think so. The math makes this outcome unavoidable. So where does this end? The dollar found its footing today, up 0.37% to 96.27. But sentiment remains fragile. Markets are bracing for possible coordinated currency intervention by U.S. and Japanese authorities. The Fed decision comes tonight, with Powell potentially addressing political pressure for the first time. And gold sits at record highs while the world watches. Here's the sentence that tells you everything. Guy Miller at Zurich Insurance said it directly. I don't feel the administration is in any rush to try and arrest the decline. That's not speculation. That's strategy. A weaker dollar makes American exports cheaper. It makes American debt easier to manage. It shifts the pain to trading partners holding dollar reserves. And who pays the real price? You do, through higher import costs, through eroded savings, through a cost of living that rises even when your income doesn't. This isn't noise. This isn't politics. This is a monetary shift. This is confidence in America quietly breaking, slowly, methodically, but unmistakably. The ECB is worried. Asian central banks are watching. Gold is screaming the answer. And by the time most people realize what's happening, the repricing will already be irreversible. So what do you do with this information? 3 things. Cold, logical, no emotion. First, understand your dollar exposure. If your wealth is 100% denominated in dollars, savings, investments, income, you're making a concentrated bet that this trend reverses. That's not a plan. That's a gamble. Second, watch the Fed tonight. If Powell acknowledges political pressure, expect more dollar weakness. If he projects confidence and independence, expect a temporary bounce. Either way, the structural issues don't disappear. Third, recognize what gold is telling you. When the oldest store of value hits record highs while the world's reserve currency hits multi-year lows, that's not noise. That's the market pricing in a new reality. None of this is advice. All of this is arithmetic. I've spent my whole career trying to understand incentives, and right now, the incentives are screaming. The administration wants a weaker dollar. The Fed is under siege. Capital is rotating into hard assets. When trust in money cracks, everything priced in it must reset. This isn't about morality. It's about simple arithmetic. Subscribe if you want to think like capital, not like the crowd. I'll keep following the numbers so you don't have to guess.